Good morning. This is Jim Riggio. Today is July 3rd, 2017, and this is the Monday Market Muse. A quick disclaimer before we get started. Capital Discussion is not a broker-dealer or investment advisor. This presentation you're about to see is for educational purposes only. We have no way of knowing your level of risk and what's appropriate for you. Risk of trading options can be substantial. Please be aware of all risks prior to placing any trades. Any trades that we talk about are computer-simulated trades are believed to be accurate. However, due to such factors as liquidity, slippage, and commissions, performance will vary. Welcome. First of all, today's just a half-day session. The equity markets close at 1, bond markets close at 2. Traditionally, these types of days, half-day sessions before a holiday, especially on a Monday afterwards, tend to end up being very, very low volume days. We tend to end up getting a lot of movement one way or another, only to be undone when the markets open up again on the next full trading day, like when all of the adults get back to trading, meaning all of the large institutions. And so today is not a day where I would end up looking to saying, oh my goodness, the market's running up, I must end up adjusting right now. Usually you get a reversal, the day after. So it's a good day just to end up watching the markets. However, if you are going to end up playing momentum and getting in or getting out of a trade, getting into a new trade because there's an opportunity because of the way the market's set up, that's a great thing. If you can end up closing a trade for additional profit today, it's also a good idea. So what I end up always telling folks is that usually you don't have to make defensive adjustments today, but if you want to make offensive adjustments today to try to end up taking profits, taking advantage of where the market's moving, that's fine. One of the things that I end up writing for the Vol Vantage traders today. And I do realize, but by the way, that some of you tried to sign up and there was a challenge that you ended up having that you couldn't end up seeing the Vol Vantage or sign up for the Vol Vantage trade. So I just wanted to end up bringing up a couple of quick points that I ended up writing up before this morning's bell. And that one was the first thing was that Friday was an inside day. And I'm going to get to what an inside day is in just a minute, which meant that there's going to be extended movement. Usually, once you end up breaking out of an inside day, the fact that it's going to be a low volume day without all the market participants in it, half-day session on a Monday, it's an island day, right? Meaning that we haven't been trading for 2 days. We're not going to trade tomorrow. And so it's kind of like the Thursday after Thanksgiving in that sense. Half-day sessions tends to end up being very, very low. And don't have the same market participants. The way I always end up starting the Monday Market Muse, or the way I do my technical analysis for my Vol Vantage subscribers, I always take a look at the longer-term view. One of the things I want to end up making sure that we understand where we are. Sometimes you get so caught up in the day-to-day that you forget the bigger picture. I always like to end up starting with the bigger picture just to remind everybody we're in a really big bull run. If you take a look, these candles are monthly candles going back 20 years. If you take a look, this is on the SPY. And you take a look at the upward trend that we ended up resuming after we had all of that, let's call it election nonsense, going sideways for about a year and a half. Once we ended up resuming our move higher, you can end up seeing that we were in a pretty tight range, except for during the last 5 months, we've been hugging this upper channel line. So, that's extremely bullish. Andrew, you pointed out when I showed this chart one time, and I thought it was a great point, that the only real down month we ended up having was just March, going back since the U.S. elections. Because of the sell-off that we had in June, we barely had a negative market, but we're up again today. So when I take a look at this, the bulls have really proven that this game is theirs at this point. And so here's the bottom line when it comes to all of the probability when you take a look at support, resistance, and everything else. The probability is that we're going to end up moving up more so than we're going to move down. However, a downward move, as we've seen over the last couple of weeks, can be sudden and can be very severe. So we do need to end up paying respect to that. Before I get to the inside day, let me just show you a couple of charts. That channel, okay, that you saw, okay, for the last year and a half, that's this channel right here, except for you're looking on a daily basis. If I end up highlighting just this year's, you can end up seeing that the upward channel in the aqua color has continued to end up moving up. You can see the few times we've tried to end up breaking above it, it's been a challenge. You can also end up seeing the support line that we've had since the beginning of the year, which was rising at a pretty quick rate. We fell below it a couple of times. We're below it right now. So the question is, will we be able to end up getting above this line? A couple of the really important support lines, okay, and here's the way I draw them. I've gotten asked, or people have said to me, sometimes it's hard to end up following, okay, these charts as I go through them. What I'm trying to do is not spend a huge amount of time on them, but to try to just give you where the support levels were. So, you know, the quick of it is, you know, we're going to have resistance at 2440 above. We're going to have support at 2419 below. We're also going to have support below that, somewhere between, say, 2400 and 2405. And you'll see I drew that on another line. Okay, so that's the bottom line. Let's talk about how we end up getting there and how I end up drawing lines. When we end up having movements, okay, and you know, these lines here where we've had movements of pretty good levels of being able to end up pointing it out. What I'm going to end up doing is I'm going to end up starting on this chart because it's not nearly as busy. Then I'm going to end up showing you some more of the trend lines and support lines. Now, trend lines and support lines and price levels tend to end up being some of the most important market analysis you can end up doing because they're there, and the algos and the high frequency guys all know that they're there, and they tend to end up using them. And so is it something that works, or is it something that everybody ends up looking at that it becomes a self-fulfilling prophecy? The answer is I don't care. Okay, as long as it works and we end up seeing that it works, I'm going to keep using it. When it stops working, I'll stop using it. Okay, let's take a look at this big run up. Obviously, you know, this level right here where I'm holding my cursor right around 2300 was really important because the market had moved up, couldn't get above it. When we finally did break above it, we moved well above it. The same thing with this 2400, and I'd say a little bit higher, maybe 2400 to 2405 type level. You can see that after we had this big run up and we had this gap and we couldn't end up getting any higher over the next couple of days, we sold off and we moved sideways during March. Okay, and then when we ended up coming back up to that 2400 level, you can see that, and here, let's highlight it so it's a little bit easier to see. You can see that this yellow line right here at the 2400 level, it was resistance, We got a little bit above it, but then we got knocked back down. It wasn't until we got back up to that resistance at about the 2405 level or so that we gapped through it, and we moved all the way up to 2019, only to be knocked down for the next few days. Once we got through the 2019 level, it then ended up starting to act as support, and it's acted as support ever since. Look and see how the big sell-off that we had on the 27th, okay, the 27th for you guys, that was Thursday, right? You take a look at the sell-off that we had, I'm sorry, on the 29th was Thursday. The 27th was the big sell-off we had on Tuesday, and then another sell-off on Thursday. It was perfect support at the end of the day on Tuesday. On Thursday, we broke through it, but only to end up bouncing in the afternoon to find a close, a support level above it. So was it just coincidence that this thing ends up working? The coincidence happens too often for you to end up ignoring them. So I tend to end up drawing these types of lines and seeing where we are. So the two things that I'll end up drawing are price levels and support resistance lines. Channels are just two support resistance lines that you've drawn that are parallel. And they tend to end up, okay, working as a really good longer term range of where the market is moving, the direction that it's moving, and it kind of gives you like guardrails on both sides. Once you end up getting through the guardrails, you tend to end up changing directions if you're going through the guardrail on in this case on the downside. Over here, if we go through the guardrail on the upside, it means that things are really expanding. Now, you can have blow-off tops, which means that you have a really big move up only to come back in. But you can end up seeing, for the most part, okay, this has been relatively bullish. The support line underneath here that I drew in green was also very important because it ended up working again as basically a partition between, is the market going to end up continuing to move up when we've gotten through this and it's trying to end up going up. It's kind of nice when you have a resistance line above, because we've been hugging this upper guardrail now, okay, for even with this sell-off, we haven't really come down that far off of it. So will the market end up continuing to move up? Let me show you one more longer term chart. And this is, all of my major resistance and support lines. So let me just show you a couple of things. I end up having resistance or support lines that I've drawn from the very, very bottom of the market in March of 2009. I don't delete them all because the thing is that there's still possibilities that they come into play, although this top one ends up looking like needs to be taken out rather soon. If you take a look at other resistance lines, I'll end up drawing them for periods of time. And if you take a look at the 2016 resistance line, this blue line right here, okay, you can see that even though we ended up having this sideways movement in 2015, we hit a low in January, February of 2016, and then we had that really nice bounce up into mid-April. You can end up seeing that this clear blue resistance line here ended up being difficult to end up breaking through until, right, because if you take a look at it, we touched it at least, once over here, once over here, once over here. So this way, when we broke through it in a big way. And you can see the run-up that we had once we ended up getting through it. You can also end up seeing that once we tried to come back down through it, yes, we had come down through it, and when we got back up again, it ended up acting as support. So it becomes a pretty important line. It just so happens that this line that I drew back nearly a year ago, and let's take a look at what's going on here. This line that I drew nearly a year ago just happened to end up going exactly through the support line here, okay, of 24.19. So when you take a look at what ended up happening on Thursday, two big things. Number one, we did break through this resistance. It was going to be a major item. We've sold very hard. And let me just show you this in a 1 hour chart, okay? This way you can just kind of get a better feel for. Okay. Oh, you know what happens is that my trend lines aren't going to end up looking the same if I end up doing it this way. That's not going to work. I didn't realize Thinkorswim would end up altering them. Okay. I'm going to end up getting to where we were, and we'll end up just reviewing this day in just a minute. But you can end up seeing that here is the same, because I keep the same support lines in the different graphs. Here's the same support line, okay, from the beginning of the year, how it's slightly above us. You can end up taking a look at that 2,406 level. You can end up seeing that we cleared it a little bit here, but this was the high that we ended up having, okay, during this period, okay? And you can see that, again, was it just coincidence that the market sold off, came back down to the very highs that we ended up having on these days, used that as support and bounced back up? If coincidences keep happening and happening and happening, it's kind of important to take a look at, why they would end up happening. So if you're playing, okay, in the market during this day, And if you need to end up adjusting your position, or if you're looking to get into a new position, what a great time to get into a long position when we're approaching, okay, the 2406 level on this day. Why? Because we have a support level here. We've broken through everything. Will we slice through the 2406 and the 2400? Yeah, we might. But if we bounce up, we're going to have just a wicked rebound higher. And plus, the thing is, volatility is really, really high. So they're wonderful times if you're trading during the day to be able to take advantage of these things. Let me show you the graph that I start off every single Vol Vantage morning with, and it's to take a look at the daily movements. On the weekly basis, I go over these. We talk about exactly where we were as we have here. But on a daily basis, is when you're putting your trades on. So let's just take a look at the daily channels. Okay. A couple of things, and I think this becomes a really important item if I review this past week with you. Like I said, I do this on a every morning basis with the Vol Vantage guys. Let's go take a look at Monday through Friday of last week. Monday we opened up, okay, and you can see that here. And let's try to make this a little bit easier to see for everybody. So let's just highlight this area. Okay, so to the left of my cursor on this side is 2 weeks ago. From this area right in here is last week. Okay, the way I end up always starting my weeks is that I start with the weekly close, and that weekly close last week was this white bar. Okay, and so you take a look at the weekly close, and then you think, well, what's the probability of, how far we go up or down? One of the other, methods that I end up using to see where our guardrails are, both up and down, is to take a look at what the expected move is. The way we end up taking a look at the expected move, and do I have it here? Yeah, I do. Okay, is that every Friday I'll take a look at a close, okay, of where we ended up closing, and here, hang on, before I get to that, right, where we ended up closing was 24, 34 and a half. You can see that that's where this white line is. If I click on it, you can see there's the value, okay, and I draw it for 1 week. Okay, and I think that this becomes an important line because it kind of ends up giving you, okay, here's the center pivot point. Here's the 50-yard line of the football game. Okay, where are we going to end up moving, up or down? Now, when we take a look at the ranges of how far we can go up or down, I take a look, and I don't try to predict it. I let the market tell me where it's going to end up going. The way the market ends up telling you where it's going to end up going is that every Friday I'll look for the following Friday. So Friday was June 30th. Okay, this Friday was June 7th. And so when you take a look at any of the options chains, what Thinkorswim does, and a lot of other platforms end up doing, is that they give you what the average implied volatility is for that expiration. Only 8.5%. It was a little bit higher on Friday. And so you take a look at how high that implied volatility is, and that will end up giving you an expected move. A quick 60-second aside on what implied move ends up meaning here. The implied volatility was where we start at 8.63, and that says the following. Everybody quotes it, but sometimes we forget what it is. That's how come it's kind of good to think about your basics. It basically says that using a options model, whether you use Black-Scholes or the default model, and I'm not even, I always mess up their names over here, or a binomial model, whatever options model you're using, okay, what it ends up saying is there is a one standard deviation, which is about 68.5%. There's a 68 or 69% chance that the market doesn't move more than 8.6% on an annual basis. Now, these things are all normalized, okay, for time, and this is what it's saying for Friday. Now, we have to end up realizing that we have to have some way of being able to talk about these numbers in a normalized fashion, because it wouldn't make any sense if we had a percentage here that was for 1 week and a percentage out here 30 days later for 1 month and a percentage out at 360 days, 65 days for 1 year. So how do we end up normalizing it? We always talk about implied volatilities in terms of if they were normalized to one standard deviation for 1 year. Okay. Then what we end up doing is that if you want to see what that's implying for your specific options or trade that you have, what I end up doing is I go out to 1 week, I take a look at the implied volatility, then what I end up calculating, or then what gets calculated would be what would be the implied volatility of 8.6, or in this now at 8.7%. Okay, but not for a 1 year move, but for a 1 week move. And if you do all of the math, you can end up coming out with how many points. Okay, that implied volatility is implying that the market will move over this 7-day period. Seems like a lot of work, except for Thinkorswim's done it all for you, and the number's right there, right next to it. So it's not implying that the market will either move up or will move down, right? It's totally agnostic to market directions. It's saying that the implied volatility is implying that the market will move 19.8 points either up or down. Now, remember what we're saying here. You're saying that there's a one standard deviation or a 69% chance that the market stays, okay, and closes within that range. Okay, so that's very, very important to understand what it's implying. Okay. Any questions about that? Because I know that sometimes I've gone so fast and I have to go quickly to get through everything. But I want to make sure that on this day where we don't have a lot of market participants going on, that I can end up answering any questions. Let me come over here and take a look at my chat.
Jim, does it matter which options are used to calculate that number?
In terms of the individual strikes within that expire on the 7th, the fact that I'm using July 7th.
No, which options within that expiration? Because obviously, if you use different options, you're gonna end up with different numbers, or are you gonna end up with the same number?
No, you're going to end up with very, very different numbers. So what formula, okay, of choosing which options and which ones we give away, which formula would you think would end up being universally agreed upon? I'll give you a hint. Which one is universally agreed upon for a 30-day option, not a 7-day option?
It's going to be the same as the VIX calculation, I would
That's
assume.
exactly right. That's exactly right. And that's what everybody kind of ends up agreeing upon. So this average, and I didn't go through how it was calculated, it's calculated that Thinkorswim and the rest of the broker-dealers who end up using this, unless they're going to end up giving you some way to customize it yourself, they're going to end up going through the VIX formula, except for they're not going to normalize it to 30 days. You're just going to end up leaving it all within one expiration.
So if someone doesn't have access to TOS but has Excel, they could actually create their own indicator.
You could. I also believe, though, that this is available on IB and several others. Okay. And for TOS, right, you can end up even just starting up a free paper trading account and just end up using the numbers. It wouldn't be the first time not that I had ever just opened up accounts just to end up using their free tools, because it was cheaper to end up in. Some of them made me put $2,000 or $5,000 in there in order to be able to end up using their tools. So anyway, so that's where the number comes from. And so what I ended up doing, and I wrote it down in my book. I forgot what it was. When I did this on Friday, we were, I think it was like 22 22 point something points up or down. As you would expect, there's less time right now, so it's going to end up moving less, but we've also moved up rather high. So let's take a look and see the way I actually draw that, okay? The way I actually draw that is as follows, and I have to end up making this just a little bit, it was a little bit bigger. So here's the center line, okay? What I end up doing, and let me make it here. And so this center line here is at 21, I'm sorry, 22, and I forget, let's take a look. 24, 21 and a quarter. Okay, if you take a look at the line to the top end, it's at 45. Okay, so what I did was I just took that 20 some odd points and I added it and I drew this line. Okay, and by drawing the upper line, all I'm going to end up doing is I'm going to take that expected move number, right, that we just saw on this side over here. I was going to take that expected move number that I calculated on Friday, and it's going to end up giving me bounds for the week, both upward and downward, where the market's going to end up showing at least some support and some resistance. Let's take a look at last week. And this was I'm looking at a 15-minute chart, but this was the part that I ended up highlighting. When we were going through this sell-off, and you see what I'll do is that I'll actually draw a channel, right? So we have this downward channel, okay, that we had been through for 2 days. As we're selling off and going very near the bottom, and you can see, I don't know if you can actually see this, but this little orange line right there was the low that we had for the day. What I do is I put in aqua color lines for our bounds on the top and orange colored lines for our bounds on the bottom, even if the bounds are relatively short. Well, over here, it was only here for, 2 bars. You can end up seeing. But that low was exactly the bound that we had on the lower side. Now, please realize I'm using not the SPX for this, but I'm using the E-minis. I want to end up using the E-minis for a couple of reasons. Number one, they tend to end up moving quicker. Number two, there's no lag time for every one of the 500 stocks to end up opening up before they can give me a full first print for the SPX. Now, the SPX doesn't wait for every stock. When they give you their print at 9:30 Eastern morning, if only 450 stocks are open, they're going to skip those other 50 and they're going to consider them unchanged. And so you get a little bit less accurate lines. Okay, so please realize you can't end up saying, but I thought that when this thing sold off, it sold off to exactly 24.19, and Jim, you're drawing 24.16 on this line, and that's where we came down to. Yes, that's the difference between the VIX futures and the VIX. The VIX futures, the S&P futures and the S&P SPX. If you go and take a look at it, what you'll end up seeing is that there's about 2 3/4 point difference at this point. That thing ends up getting narrower as we get closer to September, and so if there are a couple of points off, just realize I'm showing you 2 different things for 2 different purposes. One is the long-term one where I want to end up looking at the SPX because I care about the daily movements, okay? But when I'm looking at the 5-minute charts, I'm going to want to look at the E-minis. Does that make sense to everybody? Andrew, since you're the only one who ever answers me, okay?
Just before we move on, in option view, if you put up a chart, there's a little box there that says enable target, and it shows a little box to the right of the price. Now the numbers are different than your numbers, but are you familiar with that?
I'm not. Would you like to show it? It very well may. Would you mind showing it? I'll give you the ball.
Okay, sure.
Okay. I'm not a huge option view user, and I don't have it on this machine. So let me just take a look and come over to you and give you the ball. Okay.
Okay. Now, okay, let's go. Actually, let's go to the S&P because that's what we're looking at. Now, over here, it's this. It says enable target. It looks like the same numbers.
It probably is. I'm looking at the range.
2417 to 2456. They're different, but in kind of in the same ballpark.
It probably is now. Remember, the thing is that it's going to depend on what model you're using for your implied volatility.
Right. And,
okay. Then you have to go through your calculation.
You were using futures prices, which are also going to be a little different, right?
Yep, and my futures price is going to be a little bit different, but it's a great example. Now, the thing is that do you have the ability? Is that just a 1 week target,
I'm
or
not
do
sure.
they?
Yeah, I'm not sure what the settings are because it's just a button here, and I guess you'd have to go and look into the documentation.
Okay.
And find out, what they're using, but it looks like it's a similar idea.
Okay, it definitely does. I saw Paul on. I know Paul, you're a big option view guy for many years. Do you know what that is?
Andrew, see if you can grab on that box and move it.
This
to the right. Grab the right hand side and pull it out. No, it's not moving. Paul, that was a really good idea. That would have been really cool.
You can expand it. There you go. So what I typically would use that box for is when you're looking at that box gives you a range. So when you go into the op scan, they have a function where it'll find you trades. So the box gets used to set the range, the length of time, and the prices that you want to look through.
Now, but how is it originally calculated? Is it originally calculated through expected move?
No, it's a manual set. You manually set it. When it opens up, the box shows up.
Right, but there has to be a default that it opens to.
Yeah, well, that's probably, you're right, and what it defaults to, is something that they'll have to tell you what they're.
Yeah, I don't know if it's some proprietary secret.
Yeah.
So why don't you ask if somebody who's Andrew, if you or anybody else, send in a question to support. Ask them how the box ends up moving, and you can tell them it appears to be the 1 week expected move. Is that what you're using, or are you using something else?
Yeah, because it defaults to a week when you first open it, and then obviously, if you change.
Okay. Now, what I found is that this 1 week expected move, because I was reading through an institutional study a couple of months ago, and what they were making the argument for was that after Dodd-Frank was passed, it took a while for the actual rules to get implemented. But the rules were basically all in and around how to end up limiting the bank's ability to get in trouble again. And one of the things that they weren't allowed to do is that they weren't allowed to, take large position risks. They weren't allowed to end up leveraging themselves as much. And so one of the ways that you could end up taking a look at taking on too much risk is that if you are going to be a seller of options, okay, and you're collecting more premium than you're paying, you're normally going to want the market to stay close to the money. How far will the market end up moving in one direction or another? What I have found, after all I did was I confirmed what I read, by the way. It's not like I did this research. what I was able to end up confirming was the author's statement that the expected move for a 1 week look out, because they have to end up running their risk reports and do a lot of reporting on a weekly basis. They're not going to want to see things run outside the 1 week expected move from weekend to weekend. And you can end up seeing just how accurate. And the same thing happened, by the way, about 4 or 5 weeks ago. We had a big sell-off, came right down to the expected move, okay, on the downside. It ended up bouncing right back up. You can end up seeing that we did break through it for, a couple of hours. Maybe an hour we broke through it, found resistance, this 2402 level that we ended up finding right here. When you add the 3.5 points, that's how much higher the S&P is than the S&P futures. The SPX is higher than the E-minis. You find that we came right down to that 106 support level. And if I had gone back here, you'd end up seeing it very, very similar. And so when you take a look, once we ended up bouncing back up, we got through that weekly expected move line, and then it acted as support. So I thought that this movement, not only the movement up, but when they tried to end up bringing it back down, they couldn't bring it back down through the weekly move. That was huge, right? That was absolutely huge and a very, very bullish sign. Okay, that the bulls were going to step in, and they're drawing their battle plans, and here's where they're going to end up stepping in. I had drawn this yellow circle to end up showing this over here. The other thing that I ended up doing was that in the morning, okay, on Thursday morning, we were in this downward channel, and so the question on Thursday morning was, would we break through the upper end of the channel just the way we did the previous week after 2 days? We broke through the upper end of the channel, and that was it. We moved, out of the channel. That was we escaped the heavy selling pressure, and it certainly looked like that. Okay, for all day on Wednesday, right? So on Wednesday, this thing is looking, pretty good, only to end up having this very large selling day. This is a huge range day. If you take a look at the high and the low, it was extremely wide. On Friday, okay, and same thing I said over here, right? This was a very bullish pattern. On Friday, we ended up opening high. When we ended up selling off, we only got a little bit below the close of the previous day on Thursdays, and we moved higher. And this all looked very, very bullish up until the selling in the last 15 minutes, okay? It was actually even like the last, few minutes that if I brought it up on a 1-minute chart, you would end up seeing. So we got this really heavy selling pressure, and many times you'll see a big movement at the end of the day when some large institution. Can you guys still hear? Okay, can you hear me now?
Yep.
Okay, sorry about that. I pulled my microphone out. Okay, what I was saying is that many times, okay, we get these sell-offs because a large institution might be moving in or out of a position. And doing this on the close is something that you'll end up seeing. There's usually these huge volume spikes. and if they're looking to get rid of, hundreds of thousands of shares, this is the time that you'll end up seeing it happen very often. Okay. Friday was an inside day. What an inside day is that our high is going to be lower than the high of the previous day, and our low is going to be low of our low is going to be higher than the low of the previous day. And it was an inside day by quite a range. If you take a look at the blue upper line on Friday and the yellow or orange yellow lower line on Friday and compare them to the low on Thursday and to the high on Thursday, really was a very big contraction in volatility. And even with this big sell-off, all we did was go from the upper half of the narrower range to the lower half of the narrow range. What happens very often on the next day after you end up having an inside day is that you now look for the ranges, because once you end up breaking through the upper range, many times you'll break through the upper range of Friday and go all the way to the upper range of Thursday. With the lower volatility, okay, that we have today, because not all market participants are playing, we may see a little bit more volatility than you would. Sometimes you don't see anything. It's just it's a more difficult game to end up playing because not all the market participants are here. Anyway, so you can
the A team is out in the Hamptons.
The A team is out in the Hamptons. With and I didn't end up actually saying this to you guys, but I did end up writing it to. Do I have it over here?
They have an app now on their iPhones that they can turn the computers on and off from the Hamptons.
You meaning they can kick out the plugs from out there?
Yeah.
Okay. Okay. So here's what I wrote to. Right? The Wall Street fable is that the children are in control today because it's a low-volume day on a half-day sessions, okay, right before a holiday, okay, and that when the parents get home on Wednesday, okay, meaning, after everything, the parents will have to clean up any mess that the children end up making, and they'll probably end up bringing it very close to the place where they end up starting. Okay, that's
now that everything's done by computers, is that true anymore?
Well, somebody needs to be around to kick the plug out of the wall.
To a degree, because remember what computers can end up doing, okay? Computers end up having a much bigger effect on the short-term moves than they do on the long-term moves, okay? Because what ends up happening is that when you take a look at, I don't know, let's use Warren Buffett for an example, because the thing is he's been in the news just recently. He's looking for blood in the streets, as he famously once said. He wants to be buying when the computers are just selling the crap out of everything. Okay, because the thing is that what the computers can end up doing is that the computers can end up still doing, and yes, there are computer models that will end up doing some of the stuff, but it still comes down to, even if you do a computer model on a long-term basis, they're going to be looking for value. Okay, they're going to be looking at buying things at certain levels. So when the market sells off and sells off and sells off, at certain point, value models will be kicked off and saying, hey, here's a good time to buy. Hey, here's a good time to buy, as you end up going down. And so when you take a look at the short-term movements that the kids made a mess, that they might run it up or down, many times you end up seeing it coming right back down within the range of where they are. So it's kind of, I would never want to end up adjusting today if I had to, meaning making a defensive contract. Oh, market's moving up, I have to end up rolling my condor up. Not today. I'm going to wait till Wednesday. Okay. Because too many times you'll see it, maybe we finish right now, we're up almost 15 SPX points. Okay. Would I be shocked if, we close at 20 and on Wednesday morning we open up at minus 10 and we're only up 10? That's usually what kind of ends up happening. I kind of let the markets do what they want to end up doing today. Now, if I was playing, for a bullish environment, as I ended up writing on the morning, once we ended up getting above, Friday's high, you can end up playing for a bullish run for a period of time. How long does it run up? I don't know. But, I'm talking if you're day trading. So anyway, those are the things that I end up seeing. Other thoughts, comments, questions?
I, I just wanted to mention on that monthly chart, the last time 1 month traded below the previous month was back in November, and I think it's now about 7 months. That's an unusually long stretch where the 1 month doesn't trade below the prior month.
Okay, and this is what you're talking about. What are we looking at here? Again, just to I'm looking at the SPY, and you take a look at the stair step, okay, going up. And even on the months that we ended up pulling back, Andrew's point was it wasn't since the election that we've had a monthly low be lower than the month before.
Right, and that's unusual. Usually
Extremely.
after 4 or 5, you do get a month that trades below the prior month. So it's a sign of the incredible strength in this market, and I think it also limits the downside because the bulls have been buying so aggressively. I think the first time that we trade below, for example, if July trades below the June low, I think it'll be greeted by buying rather than selling.
Go ahead. I'm sorry, Paul.
No, that's all right. I interrupted you. I think that you're absolutely right. Because historically at this point, that's been what's gone on, and my thinking is the same. It's we're going to continue this path until we don't, and if it doesn't, then all hell will break loose. At some point it's going to, it could be after my lifetime, but at some point, it's going to go down, and the dip buyers are going to say, yeah, I don't think so. I think I'll wait. And then everybody that's expecting the dip to be bought will panic.
Right, but the thing is, normally you don't go from bull market to bear market in equities. There's usually some sort of topping process that goes on for a while. Unlike
Absolutely.
the bottoms where, you can have a V bottom because things get so cheap that the value.
You don't have V tops, though.
Right.
No. Yeah.
So, the downside is, the downside in the S&P is probably limited to, 100 points, for the next probably couple of months. Because at 100 points lower, the buyers are going to step in.
Right. The only concern that I have is, what happened last Thursday when, the S&P at the bottom was down 1.4%, and the VIX at the bottom was up 50%.
Right, because it was just so cheap.
Right.
You have to remember the math of the numbers you're dealing with. When the VIX is at 10, to go
going
from
up
10
5.
to go up
5 points.
To go from 10 to 12 is that's a 20% move.
Right. But does that reflect back into the premiums in the puts in any way? I mean, that's the question that I have. So so if the VIX goes up 20%, will the pricing on the puts go up 20%? And will they go up 50% if it goes up 5 points from 10?
Well,
and
the time premium, it'll be the time premium that goes up.
Right, and that's I witnessed that on Thursday. I paid an awful lot of money for a put where it got triggered in the system, so I had to buy the put, and I paid a premium for it because it was, while not, I didn't bottom tick the market, but I was fairly close.
That's the challenge that you always have when you have these defensive strategies where, hey, if it gets out of my range, let me do this. Because what you've done is you basically have cut your probabilities in half because in a very, 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 very rough calculation, the probability of touching is normally somewhere close to twice as much as the probability of closing. So if you're going to saying at any point, if I end up touching this level, I'm going to end up doing a defensive trade. Okay, you just basically have cut your, or you probably doubled your chances of having to do that adjustment. Now, if you don't do it, okay, it can continue to end up selling, and so while you might be better off, most of the time by not adjusting that way, when you get hurt, you're going to get really, really hurt. So you kind of have to do it, depending on your trade management. One of the things that Paul and I have both done, and I worked very hard on the Kevlar to make I must adjust points as far out as possible on the downside, because the downside is the way where we get to in speed. The upside you tend to grind towards.
Right. That's right. And the problem, here's the situation on Thursday. We're approaching 50% increase in the VIX, and one of my second favorite day is the Boston bombing day, and that the VIX was up 44% that day. So I hit an adjustment point on that day, and the market kept going. It closed on the lows that day. So Thursday when it's going down, you have no idea. So if you have a management to protect the trade on the downside, you can't. Personally, I don't waver from it because I don't know what's going to happen next.
That's exactly right.
Yeah. On a day like Thursday, you have to maybe try to look at a vertical rather than just a put.
Of course, it moved very quickly. But absolutely, in hindsight, I would have been better off with a vertical. The problem is the vertical does not protect the trade anywhere close to paying up for the long put if it continues down. There's a dramatic difference in the performance of the trade that I'm doing. I bite the bullet and buy the first put. And after that, debit spreads work. But you're right. If you think it's going to stop at some point, not get really out of hand, the debit spread would have definitely been my better choice after reviewing everything. But at the time, who knew? And frankly, I didn't. I had it all queued up, and by the time I pulled the trigger, the VIX went up, another 5-6%. So things happen fast when they get.
They do. They do. For those of you who are car fans back in the 1980s, you will remember the Porsche commercial. There is no substitute. So Paul and I used to end up joking, Porsches and puts. Okay, in a bear market, fallout like that, there is no substitute. Yeah. And so, Paul, one of the things that I know that you're busy launching your service, and I've been busy because I have a bunch of stuff that I need to end up getting done for our capital discussions. But the movements up and the ranges that we end up having on like the 29th, where you're talking about how there was this huge spike. There's also the spike on the 19th of, the 17th of May. Okay, when you take a look at these level spikes, and what I'm seeing, okay, and what I'm in the process of actually doing another one of my distribution studies is, but not the distribution of movement. Okay, that's a little bit different. I'm going to have to end up looking at the distribution of daily ranges, okay, and take a look at not just the distribution of them, but then start to end up taking a look at what's the standard deviation expected move, okay, as things change. Kind of like doing a very, very heavy math-based Danger Will Robinson graph.
Right.
Okay.
I think that becomes an elephant footprint, personally.
It is a huge elephant footprint because, for those of you who don't know, it was Dave Walton, right? Dave Walton wrote. He's written a couple of different papers Dave Walton heard me speak one time about how many times what happens before the markets go down, you'll start to see the daily ranges, okay, the daily ranges of the S&P get wider. Okay, this is a concept that Chaikin and Bollinger Bands are based on, and there's been a lot of other work that's been based on. In fact, taking a look at the movement of the daily ranges, the fact that Bollinger Bands went into they went into using standard deviations became very, very important. In fact, here's one of the other graphs that I end up going over. I use in my weekly review for the Valvantage subscribers. What you're looking at here is the red line on the top and the red line on the bottom of the 100% linear regression channels. You're looking at the 50 linear regression channels in the dotted lines, lower and upper. It's much more difficult for an index to get above the 50 lines, whereas stocks and individuals can end up easily getting to their hundreds. And so that's why I wanted to have both of them. The other thing that ends up happening is that if you take a look, and if you've read about John Bollinger and how he ended up creating the Bollinger Bands and what they ended up meaning, he started with a 20-day moving average. Why? Because he thought that that was the de facto, and it is. It's kind of like the de facto standard that the industry uses on shorter-term movements, okay, and which direction it's going. And then basically he's taken a look back and taking a look at a one standard deviation movement based on the recent distributions of the underlying. And when the Bollinger Bands get narrower, and they get narrower symmetrically, okay, if you can end up seeing that they come in on the top and they go up on the bottom. And so what ends up happening is that he's looking at what the standard deviations are. So they tend to end up getting narrower. Now, what ends up happening is that when they get narrower, there's a compression, and many times that compression is like compressing a spring, and when it pops, it really pops. And so when I take a look at what's going on with the VIX, you can end up seeing that you'll have these big movements, and they'll keep the Bollinger Bands very wide. And then after 20 days, when they fall off, they get narrow. This is not a good way of looking at it. You can't end up taking a look at, well, if the VIX ends up going in 20 days, this is what ends up happening. Now, in addition, remember, the VIX...
That's only capturing the close, too.
It's only capturing the close.
So,
it's
like
only
on Thursday, you're not getting the effect of the full day.
That's exactly right. That's how come, okay, and I want everybody to see Andrew's point here. Take a look at the huge spike up, okay. We came back down and closed at a pretty normal level. However, we didn't have really that much of an expansion in the Bollinger Bands because the close was only here. So, Andrew, one of the things you have to do is actually like pull down all of the data and do stuff like get the daily changes, get the ranges in percentages, and then start to find out the standard deviations based on percentage change, and probably even more important, take a look at listing out the ranges. Okay, and I'm looking at daily ranges here, just like in the other distribution study that I ended up doing, where I took a look at it, where I could take a look at 1 day or 5 day or 20 day or 50 day, okay, ranges. I'm going to have to end up doing the same thing, and then compare the difference of the standard deviation changes in the ranges in the short term versus the long term, and that's going to end up giving me, I think, a great elephant footprint. I'm just, a couple of days into this project, but it's, I think it'll be a very, very worthwhile one. The other thing is that because the VIX is based on the puts and calls of the S&P, you get a lot of market participants who might be looking at oh, I need this special situation, so I'm going to end up putting this in. You also don't end up seeing, well, what happens if I'm going to trade this long butterfly in this month versus this short butterfly in another month, or whatever institutions might end up doing. Some of the calculations may be considered. Think about a really wide butterfly. You may have two of your three strikes counted towards the VIX, and the third one might not count during the VIX. And they may think that your trade was incredibly bearish, when it was actually kind of neutral, but they didn't count one of your strikes, right? So there's issues in and around. I think you'll see more market noise in the VIX than you would in the VVIX. And so now remember, the VVIX is the volatility on the VIX options. I thought about using the actual VIX option, using the VIX futures. Remember, the VIX options are priced off of the VIX futures. And I'm actually going to end up doing my study with all three. I'm going to take a look at front month VIX futures. I'm going to take a look at the problem with using just the front month VIX futures, and the reason why I don't want to say I've already eliminated it, but I'll do some of the work. Take a look at the gaps that you have on expiration, right? When you go from having the active contract being March versus April, you have this big jump in there, but that's kind of normal. So it's going to mess up any of the studies that I'd want to end up using, okay, for the VIX futures. So I can't use the VIX futures. Okay, I know it's already going to mess everything up. So what's the next best thing? Probably even better than the VIX futures would be the VVIX. And so that's what I'm going to end up doing. I'm going to end up using the VIX and the VVIX and take a look at the ranges, and then start to take a look at Bollinger Band-like movements. Okay, but using ranges and also changing my distributions. 20 days is way too long. You know, maybe I compare a 5-day to a 20-day or something like that. And by the way, this was the basis for the Danger Will Robinson graphs. If you guys have never seen those, and this will be the last thing that I end up showing, but this was the work that Walton and I had done. What he was basically doing is that he was comparing the average true range and looking at the probabilities, doing a Paul, do you remember the name of the distribution when you use a really, is it a student T distribution?
Oh, you got me.
Okay. Anyway,
Sorry.
There's a name for when you have very few sample sets, you have to use different types of distributions. And so he actually wrote the code to take a look at a 3-day versus a 30-day, and when is volatility starting to end up moving differently. And the problem was that, and I should probably call up Dave, and take a look and seeing when is that volatility starting to end up spiking differently, and is it the beginning of a market that's selling off. If you take a look at this movement that we've had, if you take a look here, we've had a lot more, I don't want to call it noise, but when you take a look at the other spikes, let me just take a look at a spike when, that period that I know we all love. And you take a look at that period in late, take it easy, Paul, I know you're flinching right now. That in late August of 2015, when we had a really big spike, you tend to end up seeing this. Right? You tend to end up seeing a very quick spike on the shorter term ones, 3 versus 30 days and 9 versus 90 days. You need at least an order of magnitude different when you do student T distributions. But you can see how quickly they ended up spiking here. And you do get other spikes that tend to end up being a little bit flatter. But your challenge is that when you take a look at any of the really big movements, and like if I take a look at this period, take a look at, the movement that we ended up having when we ended up having the very, very big, and this is when the U.S. government was thinking, well, maybe we just won't increase our debt limit and we wouldn't be able to pay our bills. There was some serious spike in volatility here. And so what this tends to end up doing is it tends to show you quickly when there's volatility, but what's happened if I take it up to recent, right? If you take a look at any of the periods, and I'm looking at the bottom piece of it, okay, you see starting to see a lot bigger spikes where we'll end up moving higher. And when I come more recently, this is becoming a current event, but we don't have any big spikes. If you take a look at how many spikes we've had here, okay, they've gotten us into the red, okay, when things are supposedly starting to get really scary, but we haven't had any spikes above, 16. But yet we're having all of these.
That looks like it could be a function of, again, the math. When you're starting to deal with numbers that are so low.
It definitely can be, and that's why one of the things that I have to end up looking at when I do my math, and you can see here, this is just one of the spreadsheets that I've started and stuff. Not only will I have to look at changes or ranges, but I'm going to have to look at them in terms of dollars, and I'm going to have to take a look at them in percentages. And I can already tell you the way that I'm probably going to have to end up looking like this, and Andrew, you kind of hit the nail on the head with this one, is that I'm probably going to have calculations for, when the VIX is, let's say, lower than 15, when it's between 15 and 25, and when it's above 25. That's my gut feel. Where will those, when will the VIX start to end up acting differently? I don't know. I'll do the math and I'll find out.
Oh, Andrew, I just got time. I built a new skew graph sheet that just works off of the DTEs instead of dates. So some point I'll show you what I've worked on. It is much different.
Paul, we've already been going for a while now, and I know there's not a lot going on in the market. Do you want to save that for next week, or would you like
Sure.
to do it now?
We could do whatever you like. That's up to you. Just take.
I'll tell you what.
I have it all queued up. I can just.
I'll tell you what. I'd like to see it if everybody doesn't mind the fact that we're going over. I think it would be great to see. Let me just give you the ball. You guys don't mind staying a little bit longer, do you? It's not like there's a lot of stuff going on in the market right now.
Yeah, and the Hamptons people are going to miss out too.
That's a good thing. Okay, you have the ball now, Paul.
Oh, okay. Okay. So, I just wanted to show the SPX graph of the time frame the historic time frame that we're going to be looking at. This is 2013. So it starts somewhere in the beginning of February and goes to June. So right in this area. So I took to heart what you suggested. And instead of going back dates, now it just looks for, this is the start date, this is the latest date, which you see here. So it's just looking for the skews at 32 DTE going out in time. So you can see now it goes from 610 to 24. So every line here is a 32 DTE skew.
So now you're really comparing apples to apples.
Correct, yeah. And so this is actually, where are we? 2437. So this is at the money here. Skew is angle is fairly similar.
Although implied volatility is lower.
Much lower.
The volatility is lower, and I'm surprised the angle is the skew is slightly lower. Looks like to me.
Yeah, does to me too. And that shows up in the pricing of my trades right now. Where I'm now trading out at the wingtips. Stuff I'm looking at is trading down, this area. So the pricing has gotten weak even out here.
That was one of the things, Paul, right? We used to end up seeing when the IV was really, really low. It used to end up being that if you bought butterflies far below the money, they were still they were reasonably priced, because the thing is that the implied volatility would be higher because it used to end up being steeper that far below the money.
Mm.
But now, if it's flatter and you're going that far below the money, it's getting even more and more difficult.
Right. And as I watch this, during, current trades, when the vol spikes, this part of the curve goes up and this part does not. It's not, it doesn't move up evenly. Where you could see this, if you look at the graph, there are times, especially towards the end here, where the vols are picking up. And you have a few times in the middle where the vols picked up. But, so let's take a look at, so that's, the vols tend to spike up. So, if you look there, and let's take a look here. So this is kind of acting normal when the vols spike up back in 2013. The line would get flatter. This is in a lower vol environment. But now we have this environment. And what's happening is it's starting, when the vol spikes up now, it tends to look like this versus the whole thing move up. And it's really kind of an odd time. But that's why we did a lot better in 2013. And this is fairly typical when I change the dates up until, the last date I have. Then it all looks kind of like this.
The other thing too, Paul, that I don't know if you could end up showing, but you're showing historically of how things look at 32 days. Could you type in, if let's just arbitrarily double it to 64?
I can. Let's see if this.
It's going to be flatter, and it's going to be flatter because what happens is that the at the money is going to be higher.
I can do 74.
Okay, 74 works.
See how long this. I have to do some more coding. This thing takes a little too long.
Yeah. What you're going to end up seeing is that in general, okay, there you go. Right? In general, the at the money had moved up. Okay. The below the money had moved up, but not nearly as much, and so our lines aren't as steep. One of the things that I've done in my Kevlar is I actually started my September trade while my July is still open. I actually have 3 of them open at this point because I needed to make capital available, because I have to end up taking advantage of the little bit higher volatility, not that it's very much higher, and the little bit flatter put skew further out in time. So I'm being forced to end up pushing my trades to longer DTEs and narrower butterflies, which means that it's going to, by definition, right? I have longer time and I have narrow butterflies, so by definition, guess what? I'm going to have to end up adjusting them more.
Correct, but when I look at the butterfly pricing, the narrower flies are actually a little more normal than the wider flies as far as the pricing goes. I haven't checked today because I'm not. Sitting on my hands today.
Do you have data for the Russell too, or just the SPX?
I have data. I haven't been updating it because I've been just trading the SPX, but the database does have clean RUT data in it from, I think, 2011 till the middle of 2016, which I could download and clean and put in there with no problem.
I mean, there's a big difference right now. You put up a butterfly in the SPX and a butterfly in the RUT, and the peak of the T+0 line is much lower in the SPX than it is in the Russell. Which
right,
is kind of interesting.
that wouldn't surprise me, and that's probably a project I just get because I'm not trading the RUT. I don't spend the money on the data, but I can do that. It's not that expensive. Just takes the time to clean it and make sure the graphs
work. You're not trading it then.
Yeah. But who knows? I mean, if you go back and look at it and it's functioning better to make money, then I probably should be trading it, right?
It's just, there's seems to me that if you view the T+0 line in the butterfly as an indication of, market expectation, then there's a big difference between the Russell 2000 and the S&P 500.
Sure, isn't that? I mean, the Russell has been performing different as well, right?
It has been. The ATRs in the Russell are actually bigger than the ATRs in the SPX. One of the things that I've shown in the past, and I can end up showing maybe next week, is the distribution of returns of the Russell has widened during the last couple of years, while the distribution of returns have narrowed, meaning that the daily return on how much as a percentage, the Russell's moved up and down versus how much the S&P's moved down. The Russell has actually gotten wider, and the S&P has gotten narrower. And the reason, right, everything, all the theories about why things had gotten narrower, they have to apply to both, right? If for example, if companies aren't allowed to take as much risk because of Dodd-Frank and their margin requirements are higher, well, that affects everybody.
Right.
Okay.
See, I thought the only thing Dodd-Frank required the banks to do was just not lose money any one day in trading.
Pretty much so, right? It reduced their risk, right? It reduced their risk, and so what ends up happening is that you go and you take a look at that. The only difference is that the algos and the high frequency guys don't touch the small caps as much as they touch the more liquid, bigger cap stocks. And
I think, don't you think that this whole game now of this active investors turning passive investors and all these ETFs, where now there's over $3 trillion in ETFs that the ETFs tend to drag up everything.
Mm-hmm.
So it leads to floating all boats and.
Yes, but to a degree, Paul. Think about this. It was the FANG stocks that pulled the NASDAQ higher than all the other indexes.
Sure. Absolutely.
Right? So if you are going to end up seeing anything get dragged higher, it'll end up being indexes and it'll end up being the highly liquid stocks.
Right. Well, but if it's, the NASDAQ's 43% technology, all technology. So if the ETFs if everybody's jumping into the tech ETFs, which are heavily weighted on the FANG stocks, they also do have the other stocks in. So it just, irregardless of whether a company is good or not, their stock goes up or down based on the ETF at some point.
That
yes.
definition of what technology is pretty loose, too. Because
yes.
a lot of stocks that are, in that technology category are not really technology. Just because you do things over the internet doesn't mean you're really a technology company.
Oh, sure. The great example is if you look at what's the favorite financial ETF everybody uses?
XLF?
XLF. If you look inside and see what's inside, it's not banks. There's a lot of stuff in there, insurance companies. You'd be amazed when you look to see what's in that ETF.
Right, because it is the financial services, and
right.
Some people don't end up realizing that. It's financial.
By that definition, GM should be in there because GM is basically a financial services company.
You might find them in there.
At one point,
I was completely blown away by what was in that index, to the point where I don't view that as as an indicator of the true banking sector health. I mean, you have to use the regional banks if you want to get something a little more pure. You know, they've kind of put stuff in there that just doesn't belong. But the point is that, you know, how much of this is individual stock trading and how much of this is ETFs? And then what happens when some of these illiquid ETFs have a bad day, like August 24th?
Just like real quick, the top 10 holdings of XLF, J.P. Morgan, Berkshire Hathaway, Wells Fargo, Bank of America, Citigroup, U.S. Bancorp, Goldman Sachs, Chubb Limited Insurance, Morgan Stanley, and American Express.
All right.
You know, PNC Financial, MetLife, AIG, Bank of New York, Schwab, BlackRock, Prudential, CME, Marshall McLennan, okay, Capital One. You know, so those are the types of companies that end up making up the XLF. You know, would you think CME should be part of the? Well, it is, right? It's a financial company. Okay. Anything else? Anybody?
CME is really more sophisticated eBay.
Yeah.
Right. You know, but you've got to kind of look under the covers. Yeah, Aflac's in there.
Yeah. How about this here? Okay, I've gone down to number 30, or I number 40. Willis Tower. Okay, Watson. Okay, PLC is in there. By the way, for those of you who don't know Willis Tower, you probably know it by its former name, the Sears Tower in Chicago. You know, you got real estate companies in here if you keep going down. So yeah, they'll end up being a whole bunch of different people, and you have to realize that when they get bought and sold, they're all capitalized, weighted, which means that the most money will go into the biggest companies. Which means that when you end up buying the NASDAQ, okay, you know, Apple and Google and Microsoft will end up getting a lot of money, okay, for every, you know, QQQ share that you buy.
Right.
Okay, and so they have that liquidity plus the liquidity of other people trading, and so yes, you get stocks that end up moving quite a bit. And by the way, if you're a long-term investor, Paul, you know our friend Andy. Okay,
yeah.
You know, he's a retired Merrill Lynch guy who sits at home and trades his own account and does whatever he wants, plays with the dog mostly these days. But I say that jokingly. But he would never invest in things that are part of indexes. He's looking to end up seeing what companies are doing the absolute best that are in the small to micro cap area, because nobody else wants them, and he can still end up playing the game where he can end up looking at their balance sheets and reading their annual reports and reading their quarterly report announcements, their press releases, and actually dig in and do homework on the individual stock and saying, okay, you know what, the high frequency guys aren't going to end up messing this thing up. And he holds a portfolio of, a dozen or so small cap positions, almost the way Buffett used to end up working, where it didn't have a lot of investments, but invested very heavily once he did his homework and ended up deciding. And he's done incredible over the last, 5-6 years. The problem is that because
he's playing in probably a non-crowded arena too.
Exactly. He's playing in a non-crowded arena where he can still use his skill sets. Now, the problem is that because they're smaller caps, he's got a pretty strong constitution, meaning that I've seen him make a ton of money and see him lose a ton of money, okay? I kind of end up joking with him. His portfolio is at the size now. On good days and bad days, I would end up calling up and guessing how many Porsche 911 turbos drove into his garage or out of his garage. And so, but when you do your homework, he's the type of guy here. Here was like one of my my two favorite trades that he's ever made. In November, okay, after 9/11, okay, in 2001, when people started realizing, oh my God, it's so risky to travel. We don't know what's going to happen. And then all of a sudden it hit everybody. Holy crap. If they can do this to an airplane, what happens to an ocean liner? And at that point, nobody was ever going to take another Carnival cruise as long as they lived. He freaking loaded up the boat at that point. Okay, one of my other favorite trades he ended up doing is that I live down here in Florida, and so does Andy, so does Paul, and the Gulf spill of the BP oil drilling rig that ended up leaking and causing such a ecological disaster. Down here, we were seeing on the nightly news every single night, somebody in a hazmat suit picking up a dead bird or animal on the shore, okay, just filled, okay, and soaked with oil. When that went one full week without that being one of the stories on the nightly news, he loaded the boat on BP. Okay, he really is very Buffett-like in that sense. When people, okay, he ends up saying, okay, some of my best bets are when, his former institutional friends ends up saying to him, "What the hell are you doing?" Okay, because when I get a lot of those, he goes, "I know I've made a good decision." Okay, so but you can't end up doing that if you're trading shorter term. You can't end up doing that if your favorite stock is Apple. It's got to end up being those companies when they're solid management, good business plans, and they're just getting the crap kicked out of them. Or you have to end up being able to do your research, as you said, Andrew, in a non-crowded field. And so I'll have to give him a call. I'll see if I can't get him to talk one day. He really is a very interesting guy. Any other questions, thoughts, comments about the markets? You want to type them in? Sure that
Jim, I have a question for you. With the VXX, I mean, when you get long the VXX, you're looking for a big move.
Yes.
I mean, you really. Do you think that there is a threshold of volatility below which it doesn't pay to get long the VXX?
No, I don't think that. I think that when I want you to realize that what I'm doing in VolVantage is that I'm basically playing momentum. Okay, since I started, sharing my VolVantage trade back in November, I've only got into the VXX once, and that was going into the French elections about a week beforehand. And so when I get into the VXX, it's never going to be when volatility is super low. It could have been super low, but it's starting to increase. I want to end up seeing an increase, and I want to end up seeing the increase in the VXX be justified by not only how it's created, right? For those of you who don't know how it's created, the VXX is always going to be a combination of being long the first and second month VX futures. Okay, so not only do I want to end up seeing the first and second month go up, and I want to see the first month go up more than the second month, but I also want to end up seeing that be affected in the term structure, meaning I want to see an increase in months 3, 4, 5, and 6. I think that if you don't see, an increase in the longer term months and just the first month or two moves up, and the difference between the first month and second month, narrows. Usually the front month's always cheaper than the second month, and that's cheaper than the third month. And if the back months ever get more expensive than the front months, we call that going from contango to backwardation. And so I want to end up seeing all of those things happen. I also want to end up seeing an increase in the VVIX, because the VVIX is the options on those VIX futures. I know they're not priced or they're not legally options on futures. They're options on the VIX, and they're traded as a regular stock. But we all know that the VIX, options will end up pricing off of the VIX futures. And so, yes, I will end up going. Now, would I end up going into the VXX when it is, 9 or 10 or 11? No, but what happens if it was 9, 10, or 11 and then got to 13 or 14 and all of those other things happen that I just mentioned? Well, yeah, then I would end up getting into it because I know that it can spike from, 13 or 14 up to 22 pretty quickly. And if that happens, that long VXX trade will end up making a nice chunk of change in a very short period of time.
It'll be safe to get into VXX in a couple of weeks when the VIX gets to 0.
Well, see, that's the problem. Okay, if the longer term ones aren't, okay, your contango would actually end up destroying it on the daily roll. And
Yeah, right.
I say it kind of jokingly, Paul, but because we've gone over this, it's the math of how these things are calculated and how they have to end up being traded on a daily basis. Now, because what happens is that they have to be rolled every single day by the fund manager. And so many times that rolling, okay, ends up having a much bigger impact on the price of the SPX, of the VXX and the XIV, or whichever other favorite VIX-based ETF, ETNs you use. So understanding.
Yeah, what is it, like 5? You lose 5% a week in the VXX?
No, not quite that much. The answer is it depends, right? The way you have to
only when I buy it does that happen.
Okay, so like for example, okay, right now, the VIX. You know what? Since you don't have the ball, let me take the ball back and I'll actually show this to you because it'll be easier, I think, if I do it this way. So what you're looking at on this graph, and I know my graphs again, I've been told, hard to follow. So the 30-second intro on it is that the candlesticks that you see right here, these are the actual VIX. I'm looking at a 15-minute chart going back 20 days. Okay, the aqua color line, and you can see that right over here. The aqua color line is the VXN contract. The N contract, so that you end up knowing, is July. This is the part that I can't make simpler. This is not my rules. These are what CME calls them. And so the N contract is July. The Q contract that you see right over here, the Q contract is green, is August. And the U contract that is in yellow, okay, is the next month, okay, which is September, and then V is October, and I have to redo that line because I messed that one up on V. Anyway, so if you take a look at the first 3 months, what ends up happening is that this was the spike on Wednesday. On Thursday that Paul ended up speaking about, and now. This spike that we see over here was a lot different than what we saw a couple of Fridays ago. This one was really serious. Okay, it was really serious because it looked like we were going to break down, and we didn't know how far we'd end up going. But if you take a look at how everything moved up, and this is what I mean in the difference in the futures. You see how this ended up continuing to go up, Andrew? I wouldn't go into the VXX unless this got closer. These 2 months got closer, and there was some type of follow through with the longer term contracts. I do this on a math base on an Excel sheet, so I don't update the chart as much as I probably should. But this is also a reason why you wait to the last half hour to trade, because a lot of times you get noise in the middle of the day. And so, yes, could it have moved even further on me? Could I have got? Yes, I could have. I get that. But over the long run, okay, taking those, 10 or 20% hits, once every few years when it just keeps going, okay, and you did wait to the end of the day to close out your position. And you can see what's happened is that they've gotten back to normal literally within a few hours. Okay.
It was really only the first 2 months that got out of line.
Yeah, but they got out of line, but these did contribute, meaning that they were moving up. Okay, if they stayed flat, if I go back and I take a look at here, look at this, this movement. Maybe I made that too much. I wanted to just highlight. Take a look. Did these really move very much at all? Okay. I mean, they almost I mean, they stayed very flat. So this was a non-event to me. The next day we went up even higher in the VIX. Okay, and the shorter term futures went up. But again, look at this. We didn't move practically at all. Okay, so the long term stuff told me, don't worry about it. Okay, this one I worried about. I went, oh crap. Okay, and so those are the
July, August looked like they were going to go into backwardation for a minute.
Oh, well, take a look at this. They touched. They actually did go in. If I go down to a 1 minute chart, I got to go back. Let me do it this way. Can I go 10 days, 15 days? I can go 10 days. Chart, look at that.
Yeah, one tick.
Was that the reason why we found a bottom also? I mean, I know we hit the bottom of 2006, okay, on the S&P, on the SPX, and what was it, 2002 and a quarter on the E-mini futures. That and the fact that the market didn't take itself into backwardation. I mean, it was at right. It was a point, okay, at this point where everything ended up hitting at one time. And if the Bulls weren't going to step in there, the game would have been I think, done. But if you take a look at, yes, it doesn't seem like a lot, but if I come out to here and you take a look at the V contract, right? The V contract is the October contract. We moved from 14 and a quarter up to 15. But look, the VIX itself got higher than the October contract. I mean, it was kind of weird. And this is the problem. Okay, these things are going to be happening quicker and quicker and quicker because all of the high frequency guys and algo guys all trade the VIX futures, the VIX options, and the VIX ETFs. And so there was movement higher here, but perhaps not as much as we would have normally seen. If I come back to, the way I like to end up looking at this is that, I don't want to end up getting too crazy on any of this stuff, but what I do want to end up seeing is, here's where I wanted to do it. Right? You can definitely see that there was an increase. The other thing that I end up going and taking a look at is how many days or weeks have I given up of the normal deterioration? Here's what I mean. Take a look that over time we go from upper left to lower right, that the VIX futures lose their value with time. So we have this, right, we're at our low here, okay, when we're looking at our what month was this? This was our October. V is our October. So when I take a look at the VIX futures, okay, during this half day, we went all the way back to this point. Okay, so this point was back over here. So we lost about 2 weeks of our decay. Okay, so I will end up looking and saying, well, how big of a spike is this? And what have I given back? And so if I'm playing this for a longer term view, I can see at what point do things start to end up getting scary. And that's what I had done. All I had done, by the way, in my VIX futures and analysis and my VIX analysis when it comes to my Vol Vantage trade was that I just put all of the stuff in an Excel spreadsheet and tested for probably about 100 different things that I thought could have been elephant footprints. And I narrowed it down to the 5 biggest ones that I ended up seeing. Okay, and usually one of those things will end up cracking. I will tell you that at this point over here, okay, I was out of my long XIV trade according to my rules, but I also ended up saying, no, you don't make a trade before 3 p.m. Not out of haste like this. If there's an opportunity for you to jump in early, always do that. But when it comes to closing your trade or stopping yourself out, I found that it's usually best to wait for that last hour of trading, because by that time the big boys will end up stepping in, okay, in one way or another. Your lows in a sell-off are usually always going to end up being you know, at some point when the selling is, absolutely horrific. Do they sell in through the end of the day? Many times that will happen, but more often than not, you don't close at the very lows on days when you have that type of horrific selling. You get some type of bounce. It doesn't mean that it can't end up continuing to go. One of the things that's happening in high frequency trading is that we're getting a lot quicker movements up and down. If you guys remember, we talked about the recovery after the Brexit vote, right? It took about 3 days. Okay. If you take a look at the recovery after the U.S. election, U.S. presidential elections, we recovered in a few hours overnight. If you take a look at the recovery of some other things, they're happening in shorter and shorter periods of time, that the bulls who want to end up buying are taking the opportunities, as you pointed out earlier, Andrew. They're taking those opportunities to step in. When does the entire sentiment change? That's more difficult to predict.
When it stops working.
When it stops working. I ended up writing to my Vol Vantage guys. I said, this is a pattern that just keeps happening over and over and over again. I said, I guess that we're all feeling a little bit like Phil Connors. Phil Connors was Groundhog Day, if you remember. When Bill Murray's character in Groundhog Day, where it's just the same day over and over and over again. When will you know that it's not going to happen again over and over again? I can tell you that the sign is going to be a little bit less subtle than having Ally McDowell wake up in the bed next to you. When will it stop working? You'll see it. It will end up breaking. It will end up breaking. And this is one of the signs that it had broken. Okay, without question, that it had broken midday, but by the end of the day, it fixed itself. It fixed itself. And
It'll be interesting to see how long it takes now for volatility to make a new low.
Yeah, I will tell you that the first two contracts, okay, are closer, and you can see it here, right? The first two contracts are closer together, right? The July and the August are closer together than they were here. But this is more so because the difference between the second two contracts has gotten wider. If you take a look at the difference between the first and the third month contracts, both before and after, they're pretty similar. So people who just measure first and second month, okay, would have been fooled, okay, the next day, where there really isn't a reason to be fooled if you take a look, and you also take a look at a difference between, your first and your third, or, your second and your sixth. And so that's what I end up doing, is I look at relationships between the VIX futures, and then I also take a look at the VVIX, both its level and its call skew. By the way, one of the things that you'll see is one of the great hedges when volatility gets too low is that people will be buying short-term, closer to the money, okay, VIX calls, and selling farther out of the money because the call skew is so steep. Well, if enough people keep doing that, it'll flatten somewhat. And so you kind of have to take a look at the call skew on the VVIX also. And if you take a look at it, what I found was, and the reason why I ended up going with the indicators that I went through, is that every single sell-off that I've ever seen, and I went through each and every one of them by hand, okay, one of these 5 factors have tripped, okay, and so it gives me a lot of confidence that if those elephants are going to, stampede through my portfolio, at least I'll be able to see their footprints, okay, long before, they trample me to death. So.
Yep. The low in the VIX, I'm figuring Wednesday. The rate is going today.
Very well might be. Very well might be. Here's one of the things that I want to see, Paul, though. Okay. And by the way, I am still long, and I don't mind telling you, I am still long my core shares on my XIV shares. What I did say on Friday, because we had this little bit of a spike here right at the end of the day, I said that if things didn't normalize, okay, and get better, okay, today I would be closing it. Okay, they did get better. The XIV is up 1.2% right now. Okay, so it's helping. But what I don't like, Paul, is what I'm not seeing is that I'm not seeing an expansion between the VIX futures coming down as much. I'd like to see. I'd be much more comfortable if there was more separation between the first 2 months, and also, like I said, the first 6 months. There's not the drawing down of them the way I would like to end up seeing it, and if it continues, I'll have to end up getting out of my XIV trade, which is not the worst thing in the world, right? You guys, I think, had seen this. Let me just highlight this. Here's where I got into the trade, both my core shares and my trading shares. I got out of my trading shares just around here, okay? And you can see that things had started to get a little bit worrisome, and I'm glad that I got. And this happens a lot, okay? When you start to get those elephant footprints, Andrew, we were talking about, sometimes it doesn't happen in a day or a couple of days, or sometimes it takes a week or more. But I mean, you can see the shares that I got out of here that I was scared that we were going down, and we did. We went down lower, and I didn't get a buying signal, even though we kept marching up here, because the futures, as I told you, there's always going to be one of them that scares me, and so we missed this. Then when we started to end up increasing, okay, there wasn't the same fear level, which I definitely got here. So we're at a level right now where if this thing doesn't continue its improvements, meaning in the is it here now? In the difference between the monthly futures and the VVIX, I will be forced to end up closing my shares. I mean, it's not a terrible thing, right? We're up about 9% on these things. But here is the VIX. And you can see the drop that we had today. If I just look at the VIX versus the VVIX, we didn't come down as much on this thing. Wanted to come down more, right? The VIX came down more. How come we're not making new lows on the VVIX? Okay, that's one of the patterns. And then, I can't end up showing you on a graph, but the same thing happens when you start looking at put skew on the SPX and a call skew on the VVIX. So, okay, guys, we've been going a really long time. I will end up turning it over. Any last questions to anybody who's out there that we haven't talked about? And if not, I'm going to turn to both you, Andrew, and Paul for your closing comments. But let's go and take a look and see. Okay. I don't see any. Let me go back home. Nothing. Andrew, your last thoughts and comments as we get close to the end of this trading day in another hour?
It looks like this trading day is going to be, pretty inconsequential. As always, it's, the follow-through. Let's see what happens on Wednesday.
Yep, I didn't think
that's true. Take a look at the NDX right now. The NDX is down 28 points.
Yeah, take a look at the Russell.
Hang on, how about if I do this?
Up, and then take a look at the YM or the Dow. The Dow's up 196 points.
Yeah.
This is a goofy day that you just can't rely on. I'm gonna shut TOS off and just work on some programming and put my feet up.
This is, if you take a look, this is a month. If I go and I take a look at, just let's take a look over the last 5 days. Take a look at what's been going on. This white line down here is the NASDAQ. This yellow line up here is the Russell. This pinkish rose-colored line is the Dow. You can see the Dow's really moved up. The candles are the SPX, and the pink-colored line over it is the, I'm sorry, the candles are the SPY. The pink-colored line over it, the lighter pink-colored line, is the SPX. And so, yes. And so when the Dow's like this, when the NASDAQ is selling off again and is at lows for the week versus highs for the week over last week for the Russell, the next thing I end up going to take a look at is I look at the FANGs.
Right. I think what we're seeing, because when I look at the bank stocks, they're up 2.5%, 3% today. My humble opinion is this big rotation out of tech and into banking. Once the banks announced the $98 billion stock buyback after the stress test, we started really seeing acceleration in the technology being sold off and the banks going up.
Right. Two things. Okay, what you're looking at the FANGs here, Andrew, let me just point these things out. You can end up seeing the colors up here, right? And I don't have it handy, but I have a little a cheat line for you. There you can end up seeing Facebook in pink over here. You can end up seeing that the blue line, it might be easier, is Apple. You can end up seeing this one is Amazon. The more purplish color line is Facebook, right? Red line is going to be Microsoft. The bottom two lines over here are Facebook and Google. I'm sorry, Netflix and Google. Okay, yellow line is Google, and then you can see Netflix. And so they're the ones that are dragging things down more so than anything else. I just want to show you what Paul was just talking about in terms of the different industry groups. And let me come over to here, take the sectors. Let me just clean this up so I can just show just the sectors that Paul is talking about. Okay, this makes it a lot easier to see what Paul was mentioning. Take a look at the sell-off in technologies. The sector select spider for technologies is XLK, and you can see its sell-off, versus the select spider for financials is XLF. And so you can see that the sell-off in technology is kind of correspondent with the increase in financials. And if I go back even further and take a look at, let's say, over a 3-month period, you can see that they kind of are negatively correlated since the end of April. For two of the leading industry groups, look at how much technology had moved up while banking was really dragging, everything down. And now as technology has sold off pretty significantly since that Friday a few weeks ago we had at the beginning, I guess it was almost a month ago at this point, versus you take a look at what's happened with the financials.
Can you take that chart back to November? Because that'll be even more interesting.
Because take a look at what happened here, right? And everybody knew that it was small caps and financials that just ripped higher, after the election. Ripped way, way higher. Technology didn't do much of anything, after the election. But look at what's happened basically since here. And if I should put Russell on here, you'd see the same thing. Russell ended up ripping up. What makes it? The small caps and the huge banks, or the huge financial companies all did really well. Yeah, that's what did really well right out of the election. But what happened here is that with the banking, a couple of things have happened, right? One, we went through both of our phase of our stress test on the banks. They all ended up passing. They can all end up increasing their dividends and using a little bit more risk at this point. We also ended up seeing the interest rates go up. We haven't talked about this, but if I take a look at and a lot of people look at the future. Since I don't trade it, what I end up taking a look at is I take a look at the 10-year, right? Take a look at how rates have gone up, okay? Do you think there might be a correlation? And this is finance, okay? If I show you your regional banks, Paul, what's the regional banks?
B. Is it BKE? I don't think so.
Anybody tell me the no regional banks? Regional banks ETF. Okay, I will Google it.
Hang on.
There's a B in there. I know that for sure, Paul.
KRE. Sorry, there is no B.
No, there isn't. There is a couple others, but Carrie is the that's the big one. Okay. Now I want you to take a look at the regional banks. Okay, in this blue line, all financial companies here in white, and take a look at interest rates. What do you think? Might there be a little bit of a correlation there?
Sure.
Okay, so yes, regional banks. Okay, if you're actually in banking, you make more money when interest rates are higher. Okay, interest rates have moved up, therefore, regional banks have moved up. If regional banks move up, they end up also helping some of the bigger banks move up because while Chase and Bank of America all do well, XLF, as Paul ended up pointing out to you earlier, is a lot more than just the big banks. It's the big financial companies. So you take a look at that. Okay, energy and financial companies are kind of interesting, because when their prices go up, sometimes it hurts other companies that need to use their services. Technology, has moved up so much because it hasn't been that we've lost so many jobs to foreign countries as much as we've lost them to technology. Okay, there are plant-based manufacturing jobs that are never going to come back again because they're computers that do these things or robots that do these things now. So, anyway, so yes, there's a lot of factors in the market, but don't forget interest rates are going up because the market is healthy enough to be able to handle them. Okay, at least that's what the Fed tells me.
They know what they're doing.
Okay, guys, we've been going a long time, but this is a good conversation. I hope you guys enjoyed it, and I'll talk to you next Monday.
Have a good day.
You guys do also. Take care. Bye-bye.
Enjoy the holiday.
Thank you, Andrew. Bye, everyone.